welcome everyone who are attending today. We've got a really good crowd, attendee list today. A lot of people from a variety of functions in the healthcare area, including risk, compliance, internal audit, and other finance and related functions as well. So really appreciate everyone coming in on a Monday. Hopefully you'll get something out of today's presentation. It's focused on physician relationships. This particular session is one of a four-part series that Eide Bailly is holding. This is the third in a four-part series. For those of you that maybe attended, we did talk a little bit more globally on some of the key risks in the healthcare industry and for health systems. We did touch a little bit on some of the physician relationship matters in that session. Second one was on data security. And then this one is on physician relationships. We have our fourth and final webinar next week on November 15th from 12:30 to 1:30. Many of you may have seen that and signed up for it. Back in October, we had some personal issues come up with some of the presenters or one of the presenters, so we had to slide that back into next week. So we apologize for that change, but hopefully you can still make it for that one as well. Today's session is really going to be a panel session. So a little different than maybe some of the other ones that have been more speaker oriented, presentation oriented. And we really have an excellent panel. I'm super excited about it. Anna Brewer, who's a partner with Jay Taylor out of Fort Worth, Texas. Jay Taylor is a CPA firm, but really focuses heavily in the consulting area and has a very large healthcare consulting practice, which Anna plays a significant role on that. And by the way, each of the presenters will talk a little bit more about their background in a few minutes. Scott Table is an attorney with Hall Render, Killian, Heath, and Lyman. More commonly, many of you may hear them called Hall Render out of Milwaukee, Wisconsin. Hall Render is the largest law firm that focuses in the healthcare industry in the United States. So as I mentioned, I would suspect many of you have talked to Hall Render people or certainly have at least heard of them. Kristen Tafe is a manager in our business valuation services, Eide Bailly's business valuation services. For those of you who haven't heard of Eide Bailly, we are a top 25 CPA firm, certainly do audit, tax, and other consulting. Our consulting practice is fairly substantial, and our healthcare industry is our largest industry practice. And I'm Scott Sissel. I will be the moderator for today. I'm a partner with the firm out of Minneapolis, Minnesota. I have a couple roles with the firm. I head up our health system segment, and more recently I've taken on a larger role in the firm with internal audit services. So with that, maybe I'll give you a little bit of background on today's discussion. We're certainly going to try and cover a variety of matters in 45 or 50 minutes. There's some limitation given the depth and breadth of this particular topic, but we certainly want to give you some update on some of the more significant or ongoing or emerging regulatory compliance matters. As we talk through that and other areas, we certainly will touch on, things that maybe you want to think about in your risk assessment or annual compliance programming, particularly for those people that are working in those particular roles. We'll talk a bit about physician compensation and contracting, some of the pitfalls and do's and don'ts around that area. Spend some time on physician acquisitions and valuation. Kristen and Anna in particular have a fair amount of experience around the acquisition, due diligence, and valuation area, and can give you a little background on some things to think about there. And then we'll probably wrap it up with a little bit of discussion about board governance and education as well. So a lot of topics there. Hopefully we can give you some nice insight. It is a broad area, and so we'll try and cover a few things here, at least this afternoon. For those that attended the first session as webinar series, I also had the slide in here. I tweaked it a little bit, but just kind of to center ourselves a little bit around the healthcare industry. I think in the last 18 months, what we've seen in the industry is really a time of unprecedented change, not only in the industry, really in the country. And it's driven new and emerging risks, and frankly, to some extent, maybe an accelerated way of doing business in a different manner. And it's caused really all of us that work in the risk area and compliance area to step back and continually assess those risks and try and prioritize those based upon what's currently happening, what the business activities are where the organization is going from a business perspective. We've certainly seen different ways of doing business, some of which will change. I tend to think over the next year or two, as the pandemic continues to run its course, hopefully, that some will stay, and there'll probably be a bit of resetting into a new normal as to how care is delivered and how relationships are managed in the future environment. As I mentioned, changing processes and controls, changing ways of delivering services. I think organizations have taken a hard look at their business lines and services, and maybe took a hard look at how to deliver those, which ones they want to be in, which ones they don't want to be in. And certainly as a result of that, I think we see in the physician practice space continued activity in that area, and the structures and acquisition side of things continue to emerge and evolve. Finally, regulatory matters. Scott and I were talking about this just before this, and maybe over the last 18 months, given the pandemic, there's been a little bit of a step back and a breather, but I think we all expect that regulatory compliance and focus will continue to be there and will be at the forefront of operational considerations going forward. And we'll certainly talk a little bit about, this panel's group, their thoughts around this particular area. With that, maybe just one reminder for today. We're going to jump into some questions here in about 30 or a couple minutes, I should say. If you do have questions as we go through it, please put them in the chat or Q&A, and we will try and address them as we go if we can. Otherwise, we'll get back to the individual person asking the question as best we can after the session. And again, we'll be monitoring those questions just to make sure we try and address all your questions. With that, I'm going to kick it over to maybe each of the panelists to give a little bit of background on themselves and any other thoughts they have. And maybe we'll start alphabetical order with by first name. So Anna, maybe we'll let you take the lead on that one.
Absolutely. Well, thank you, Scott. And good afternoon to most of the folks, or I guess morning to our West Coast friends. My name's Anna Brewer. I'm a partner at J. Taylor, and my practice is generally related to where physicians, hospitals, and maybe external investors, where they start exchanging money with each other and making sure that every time that occurs, that it's at a fair market value level. So lots of work around valuation and around transaction as well. We write opinions related to physician compensation. We design compensation models, and then unfortunately, when we have to, we also testify. So that's sort of a snapshot of my practice. And I guess I would say that this is one of those times where I would say to those of you that are involved in compliance and risk, this is what I would put as a tough year for you to be handling all these issues. We see a lot of complexity right now. So I'm excited about this conversation and the experts that are on this call.
Thanks, Anna. Kristen, you want to jump in next?
Of course. My name is Kristen Tafe. I am with Eide Bailly, and I'm out of the Fargo office. I have 13 years in public accounting. Most of them have been spent in business valuation. I specialize in valuations in the healthcare industry, as well as valuations and transactions, or valuations and consulting in the transaction space. I work with health systems looking to acquire independent practices, practices and ASCs looking to admit new partners, and practices looking to sell 100% of operations. Additionally, I consult with potential sellers on offers that they've received in a variety of health specialties.
Great, Kristen, thank you, appreciate that. And then Scott.
Yeah, thanks, Scott, and thanks to all of you for participating in our webinar this afternoon. I really appreciate the opportunity to speak on this important topic with my fellow panelists. As Scott indicated, I work in the regulatory compliance practice of Hall Render in our Milwaukee office. Based on all the enforcement activity within our industry, my practice really centers around two main themes. First of all, we represent providers who are targets of federal investigations, and we also work with the fortunate providers who detect non-compliant behavior themselves and are able to self-report before it can escalate into a federal investigation. So we work with providers on the self-disclosure side as well. I have actually been involved in almost 150 self-disclosures to either the OIG, CMS, or the Department of Justice. I was telling Scott when we before we started the call, the timing is very propitious because today the OIG just announced an update to its self-disclosure protocol. And a lot of the self-disclosures that we have worked on in the past have related to physician compensation arrangements that are not consistent with the federal requirements.
Hey, Scott, you know, and I guess this timing is everything with the session today. So I know just working with our own clients and others that it's always a challenge. Self-enforcement and disclosure is a challenge as to what are the steps and how do you go about the steps and how do you manage that process, because it can be a kind of it can be an all-assuming process. So that's obviously a challenge there too. With that, Scott, since you're already warmed up, maybe I'll direct the first question to you, and I'll let you maybe give your perspective a bit on your recent experiences, or maybe some of the more prominent issues or matters in regulatory compliance that seem to be out there. Your perspective of those, you know, certainly Stark, anti-kickback, ECRA, OIG, those sort of things are all out there. But kind of give the audience a feel for what you're seeing and or what they should be thinking about in their when they go back to their offices, so to speak.
Sure, Scott. I can certainly take a shot at setting the stage. And really, in our experience, physician compensation arrangements are really at the epicenter of healthcare enforcement. And the reason for that is they implicate the top 3 federal enforcement statutes that we typically see the Department of Justice and the Office of Inspector General pursue, namely the Stark Law, the Anti-Kickback Statute, and the False Claims Act. And as most of you, I assume, appreciate, you know, under the Stark Law, we can't have a physician compensation arrangement unless we meet one of the enumerated exceptions. For anti-kickback statute purposes, we can't pay remuneration in exchange for the referral of federal healthcare program business. And if you have a violation of either one or both of those 2 federal statutes, the federal government believes that you then necessarily implicate the False Claims Act, because the government takes the position that all the referrals coming from that problematic arrangement are tainted, and the provider should not be billing for any of the services that are referred. And when you get the False Claims Act into the mix, then the heavy statutory damages that pertain can make it very difficult on, you know, the target of a false claims investigation, including one where the main issue is a physician compensation arrangement that doesn't meet Stark or anti-kickback requirements. You know, as Scott indicated, there was a bit of a pause, provided the government provided some welcome relief during the pandemic. You know, there's waivers, for example, that are still in place. There were recent flexibilities in the new rules that came out for Stark and the kickback statute. So those were some welcome developments during COVID. But we have already started to see the enforcement activity start to ramp up again. And in the end, you know, the recoveries that the government achieves here through healthcare enforcement are just too lucrative for the government to change course now. And we think going forward, as in the past, the main focus will be on what are sometimes referred as the big 3 for anti-kickback and Stark purposes, you know, namely whether the compensation paid to the physician or the physician group is consistent with the fair market value of the services received, whether the arrangement itself is commercially reasonable, and then last, whether the compensation paid is for the value or volume of referrals that are generated. Those have been the main themes in the past, Scott, and we do think they will continue to be so as we go forward.
Excellent. So you mentioned that you see that kind of something that may continue to accelerate in next year? Anything specific, or is it just kind of the general tone you're seeing out there in the environment, and the fact we're starting to, we see a lot of things, right? The economy starting to pick up and those sorts of things.
Yeah, and we can get into some of the more specific examples, Scott, but we do think that, there's a focus on what the government views as outlier compensation. For example, the physicians who would appear to be paid much more than is typical for their specialty. We see focus now on whether the productivity data that supports the most highly compensated physicians, assuming they're paid on a productivity basis, whether that productivity data is solid and really supports the level of RVUs that are coming out of the arrangement. And then the other area, not necessarily in an employment context, we continue to see questions about, for example, with medical director agreements, whether the physicians are actually providing the services that they're getting paid for, and is there a record related to that the provider can show to substantiate that the work was done. Those are some kind of typical themes we see, and we're seeing currently, and expect to see going forward as well.
And maybe I'll kick it over to you, given your experience and background kind of around these compensation arrangements, whether it be compliance or other related matters. What you have any other thoughts on that, or to add on to what Scott just talked about?
Yeah, I think Scott hit the nail on the head there, talking about some of the underlying data that we use as evaluators and as administrators of physician practices and hospital-owned physician practices to pay our physicians. A lot of our clients are relying on work RVUs, and I think that is a great metric. It's only a metric, so it's only as good as the underlying data. But we're seeing a lot of our clients have trouble getting that data well and making sure that it is truly indicative of the services that the physicians have rendered. A lot of times we'll see it and we'll think, gosh, we need to have a billing and coding review here because it's too high to make any sense, maybe particularly in relationship to what the collections are for those services. And we see that every once in a while. More what I would say we see often that's tricky for those that are on the call here is making sure that your calculations are taking into account modifiers and bundling and unbundling and things that payers, including Medicare, are absolutely doing to figure out how much those services are worth, and making sure that the work RVUs mirror that same methodology. So we see a lot of trouble with this in OB, when the OB physicians are maybe performing a delivery or not performing a delivery. There's completely different CPT codes for bundling and unbundling on that is caused some self-reporting issues in the past for my clients. Similarly, proceduralists, ENT doctors that do a lot of surgeries, say sinus surgeries, those almost always come in twos, right? You're doing a sinus surgery, and payers only pay for 1.5 of those, not for 2 full ones. And so making sure that your work RVUs take into account that payer adjudication methodology that comes with it, that I think is imperative in that. And then noted kind of the medical directorship piece, we for sure still see a lot of concern around stacking with different compensation components to external physicians. We saw one recently that was a cardiology group that I think had an agreement for reading EKGs, a co-management agreement for managing a department of the hospital, some medical directorship agreements, and then maybe was even doing employment leasing and leasing a building. And as a compliance individual or somebody trying to make sure that we've spent the money we're supposed to in an internal audit situation, trying to tag all of those together and note that those are all related to one grouping of physicians and that those are all subject to fair market value on a combined basis, not only just individual. That's something that we're seeing a lot of heat around that right now as well. Folks are having to report that.
Is that the concept of, I don't know, you call it stacking, obviously I've heard that term, but double dipping, where they might be getting paid for the same thing in multiple arrangement, and it comes down to, as you mentioned, commercially reasonable? Is it a reasonable amount paid for all the services they're performing?
Yeah, we're making sure that every hour is only paid for once, right? That's what we're trying to make sure occurs there. But then also just for compliance individuals, those are 5 or 6 different agreements that you need to make sure that you can track and that you have them all tied together and you know that that's all one entity, and making sure that you understand, which of those is paid on a 1099, which is not. That's just a lot for those on the phone to think through. But yes, absolutely.
To track through too, quite frankly, to be able, how do you kind of make sure you've got all the parts and pieces and parts? I mean, I've run into this in my career, although probably not as much lately. Just the contract management process
Right.
is a major making sure you have all the agreements and all the amendments and all the relationships with a physician connected, because that, I think there's some people on the phone for very large systems, and that can be a challenge, and that ties into other issues too around other related parties they may be involved in, and things you need to do around conflict of interest, which isn't necessarily a topic today, but I think those are important components too. Question for any of the group here: value-based payments. How do you look at those? I know you talked about, compensation arrangements around RVU. How are people looking at that as we move into a world of more value-based payments?
Boy, that's the question of the decade, in my opinion. We get it.
Sorry to put you on the spot.
No, we get it all the time. I was just talking to somebody on Friday about that, a health system, and my question back to the health system is, how much of your current reimbursement is related to value-based care or quality components? And really, I think where we've landed on this is we really want to mirror how much in the physician world is related to the quality and outcomes and value-based care with how the payers are paying it. And it's been really interesting to me that the different geographies of the US are very different from each other on that. So you look at the South and really Middle America, Midwest, and there is, for the most part, maybe with a couple of caveats for some geographies that are further ahead, there is not as much money in play for value-based care right now. You look at the coasts and there's a whole lot more, for sure. There's a whole lot more on the West Coast. And so what we're advising clients right now is, let's look at your entire book of business from a physician perspective, how much of your revenue comes in the door related to physician services, and then let's score how much of it is really fee for service still, and how much of it is really related to outcomes and value-based care. And let's try to mirror that in the physician comp plan. Because I think we could get ahead of ourselves since everyone's talking about this so much. There's still, particularly in Middle America, in the South, and even on some of the coasts, there's still some just straight up fee for service business that goes on.
Sure. Thanks. So any other thoughts around the compensation area from Kristen, Anna, or Scott, quite frankly, or any other other focus areas, OIG or DOJ would want to let the audience know about?
Scott, the only additional point I would make to kind of follow up what Anna said, because I think it is a very important point. The first question is really to get your arms around all those arrangements. And it's remarkable to us how many different ways physicians can be compensated, and whether you actually have an inventory of how all those payments are going out. One thing we've done recently, for example, was with a health system to actually do an accounts payable review, because there are periodic payments or irregular payments that have been made historically and continue to be made that may not be subject to a writing, but they're still paid. And so the idea was to, first of all, we got to figure out, all these places where we're paying physicians, and then we'll deal with it accordingly. So I think sometimes there's a tendency to kind of, get right to the particular agreement, and we have to do that. But it's oftentimes a good idea, though, to understand what the whole universe of those arrangements is before, you start focusing only on a subset of them. And it's, like I said, surprising what you can find when you start going through some of that detailed accounts payable data, for example?
You know, there's two other areas that I think keep people up at night on physician compensation right now, or at least they do my clients. And the first one is the survey data that's available to us. Valuators are well versed in what the norm is, or the survey data says around physician compensation. And to be real honest, we're in a little bit of a pickle this next year. The 2021 survey is generally based off of it was published. Most of those surveys were published in the last couple of months, and they're based off of 2020 data. 2020 data is pretty well broken, is what I would say, from a COVID perspective. And so what we're seeing is a lot of physicians were held steady in what they were paid by their employers, but their productivity dipped quite dramatically as ORs were shuttered, and they were asked to move over to telemedicine if they were in primary care. And so the relationship between compensation and work RVUs appears to have been disconnected during 2020. So I think there's a lot of compliance plans out there in the US that have kind of markers in them of, if you're at X percentile, you're okay. If you're at this percentile, it requires, an individual to come in from the outside and take a look at it. And I really think some of those markers, we really can't use 2021 survey data. And probably I'd argue we can't use 2022 survey data either, because the physician fee schedule changed in 2021. And the value for the services, particularly outpatient E&M services, changed dramatically. So I think I think there's consensus in my field that the 21 data is not as useful as it has been in the past. And a lot of us are just tabling it and not using it for now. But then that brings up, what are you comparing from a compensation perspective? And again, the physician fee schedule for 22, the final, just came out last week. And it's as we expected, but it's not necessarily good news for health systems or physicians. It's another big cut in the conversion factor. So if you think about it over the last couple of years, your primary care physicians maybe received somewhere between a 14 to 15% increase in work RVUs. But during that same time frame, they're likely to receive about an 8% cut in reimbursement from Medicare. So we've got two of the numbers that we use the most in the valuation setting from physician compensation perspective diverging from each other and doing two completely different opposite things. And so again, the surveys and knowing exactly where fair market value is with these changing data sets, it's really going to be a tough deal for those in my field and compliance officers really in the next year or two, as we work through how to adjust these compensation plans to account for that.
Do you see, you mentioned your compliance officers and other trying to build as much data as they can on maybe better historical information, inflation, trying to build a case around the information they do have? Is that, again, you can't point to one data set, but maybe you have to look at multiple things?
Yeah, I still think there's a lot of truth in the older surveys. So the 2019 surveys, I think we're using those with some adjustments. And then we've been helping people really calculate absolutely from scratch at a CPT code level the exact implications of the new Medicare fee schedule, both for 21 and for 22, and helping to project for them what is reimbursement going to look like in 22 with and without sequestration, which is still on the table. Because who knows what happens between now and December 31st. Last year, Congress intervened 4 days before the fee schedule went live and completely changed it. So we're having to help our clients really know economically what this means. And not that economics is everything, but it's a pretty good determination of what services are worth, what Medicare is willing to pay for them. And so we're really taking CPT code level data sets and reprojecting the adjudication of Medicare and of all the commercial payers, and then trying to keep the expenses pretty well even in prior years and let any up or down flow through to the physicians based off of what I would say an income approach or the economics of healthcare would flow through to them if they were in private practice. So it's a lot of heavy lifting, but I think there's ways to make an argument with really good objective data.
Kristen, we're not going to leave you off the hook. I might have a slight redirect here, but we still see a fair amount of physician practice activity, acquisitions, maybe even some divestitures or restructuring. Could you talk a little bit about some of the things we've been talking about today and how you look at that from an acquisition standpoint, things that need to be considered or things you think an organization should have on their list of things to consider when they are looking at a potential acquisition and obviously down the road, valuing that acquisition?
Yeah, most definitely. So just like Scott and Anna discussed already, Stark laws really impact how that physician compensation is structured, but it also goes on to impact how an acquisition can take place. So normally in the marketplace, we're going to say a purchase price in a transaction is dictated by the market. So we have a willing buyer and a willing seller, and they get to say what the transaction will be. It's a little bit different with Stark laws, or with the Stark law, because that prohibits the purchase of any referral source. So in a sense, it really says you can pay up to fair market value, but you can't really pay beyond that because that would be against the Stark law. So if you buy a practice above fair market value, it may appear that you're buying those future referrals of the practice, and then that's how you could really get in trouble. In addition, nonprofit hospitals can face additional compliance situations with just not wanting to lose their tax exempt status. So there are a couple reasons that valuation and understanding what the fair market value of an acquisition is really comes into play in the healthcare space. So one thing that is important within the healthcare space is to understand the 3 different methods that you can use in evaluation. So typically we have 3 different valuation methodologies that are going to be considered. The income approach, which looks at future cash flows and what kind of the present value of those future cash flows. You can look at that based on a single period, or you can look at a multi-period forecast. It's going to depend on what type of information is available to use, obviously. Often we would consider historical data to be indicative of future operations. However, we're in a time where that's not always going to be the case anymore. What used to be a little bit more consistent year to year is now really up in no man's land. So that takes a lot more work to identify what this future is going to look like. So like Anna was talking about, those CPT codes and understanding what your production has looked like historically, and under that same production or similar, what it's going to look like in the future under the new fee schedule. Those are things that you're going to have considered in determining the fair market value of a practice. Then we also have the market approach. The market approach is very interesting within the healthcare space. For some specialties, it's very useful. If you are going to buy an ASC, there's definitely market multiples that we can look to that can help us to understand what these typically transact at. However, in the purchase of a lot of independent practices, that's not a really good indicator because we don't have enough data necessarily on the market information to understand what was really being purchased there. Was there goodwill included in that? And because of that, we really tend to shy away from them when we're making purchases or when we're considering acquisitions that are going to have the Stark law over, as something that we would need to be considering. The last approach is the asset approach. For the most part in the healthcare industry, we're looking at professional services. And in a professional service, your balance sheet is often not your strongest way to determine value. However, under the asset approach, we can look for both tangible and some intangible assets. And that can help us to really round out the value of a practice and have that be a more reasonable way to consider value. So because of this, depending on the type of specialty, we might look to more of the income and the asset approach versus really, centering in on that market approach. So that's a little bit different than in other industries. Something else on this, Scott, is that the asset approach really comes into play here because sometimes when we're valuing these and we make certain adjustments or normalization adjustments, we call them, we're going to see that these practices that may look profitable from just looking at a tax return or a financial statement actually have negative earnings. And because of that, that's why we're going to really focus on the asset approach to say, there's still something here. By buying this, this is still a reasonable purchase. It furthers it's part of that commercial reasonableness aspect of it, furthers the mission of the healthcare system, whatever it might be. And so instead they're going to look to that balance sheet to say, what are the tangible and what are the intangible assets that I could purchase here? So just because a practice has negative earnings doesn't necessarily mean it's not a good acquisition choice.
What types of things are you seeing in intangible asset value or considerations when you look at intangible asset value? And that's Kristen or others on the panel too, whoever wants to respond to that.
I would say that the number 1 and 2 are definitely going to be focusing on the cost to recreate a workforce in place and medical records. And what we're looking for there is the fact that if I buy something you've already created, then I get to step in on day 1 and have something that's up and running. I don't have to take time, for example, on the workforce side of things. I don't have to take time listing for open positions, interviewing 5 people to fill every one position, all those costs to get people in the door to want to interview for this. And then the downtime that's necessary in order to train those individuals. So workforce in place, it's really focusing on I can walk in and everybody already knows what they're doing. What's the value of that asset? And then on the other side of things, we often look at medical records. And this is really focusing on the ideas of that's something that's already in place. Somebody already has this health information. And although that information isn't for sale, the cost of me going in and putting somebody in charge of like extracting all of that has value. If it's already in some sort of database that's usable, that has value to me. Anna, what do you think? Are those the 2 that you're typically identifying?
We are seeing those. I'm wondering, we're seeing a lot of private equity enter healthcare right now, have been for the past couple of years, but it's creating a really interesting competitive landscape whereby our hospital clients, if they really want to employ a large physician group, may have to pay a whole lot more from a goodwill perspective than they would have previously. And it's really been a challenge for valuators. But we are definitely seeing a resurgence of true blue sky goodwill deals where physicians are contractually giving up a portion of their professional compensation that has occurred in the past, meaning they are overtly, purposely taking a pay cut and carving that off, and that's going to an investor. And then as a part of that going to an investor, then that's capitalized, and that is the goodwill payment that occurs going forward. And so I think we're seeing more of that, and I think healthcare systems are going to have to wrap their head around that again. I would say probably for the last 5 to 10 years, we've not done nearly as many goodwill deals, but before that, this was much more prevalent. So I think everything in healthcare is always cyclical, right? And I think we're going to be back to that, but for a different reason, because I think there's now financial investors who are willing to do that deal with physicians. And so I think that's going to change the landscape and definitely causes some more risk items for folks on the call to consider as they implement a transaction that has had a large amount of goodwill associated with it, paid for.
And Scott, on that note, so in the valuation process, one of the most critical things that we do is normalize earnings. And the number 1 normalization and adjustment you're going to make in valuing anything in the healthcare space is going to be compensation paid to owner providers. And what we're trying to do there is say that at some point, it's their discretion how much they pay themselves via W-2 on the profit and loss statement or via distribution. And part of our job is to go in and say, okay, what's the return for production? Because that should hit on the profit and loss statement. And what's the return for ownership? Because that's a distribution. And so we want to separate those out. And that really ties in with what Anna was just saying, which is if I'm going to say I'm willing to take a pay cut, well, now I have higher earnings. So my value in a valuation is going to be higher. The fair market value of the practice is going to be higher. However, on the other end, then that physician compensation agreement, that's going to be lower. So it's almost like they have an inverse relationship. If you say, no, I want higher comp later, you're going to get a lower value for your practice now, because those have to be considered. We have to be thinking about it in the same frame of reference in the acquisition point and after the acquisition occurs.
What are, again, this maybe gets into a discussion a little bit about pre and post acquisition and what the physicians expect and what, the organization, the acquirer expects. I mean, as you look at that, taking more now, later, and less, or taking more now and less later, or vice versa. I mean, how does that discussion work, and how does that fit into some of the compliance rules? not easy, right? Anna?
So whatever is agreed to really needs to be contractually obligated to. So if a physician has historically made, say $55 a work RVU, and they're going to now on a go forward accept $50 per work RVU, then that needs to be contractually agreed to in the documents. But it really creates a future risk point also for the hospital of generally when Kristen's doing her work and she's probably projecting out for 30 to 60 years of what this business is worth. And so it's been a pain point for our practices that we work for in the past couple of years of when you get past that 3-year employment agreement or that 5-year employment agreement and the physicians think they're going back to the table to renegotiate something of what their compensation plan should be, but they agreed to get a large amount of money up front. It's really not a gloves off full negotiation because again, they've kind of already locked into something in this transaction that they did. So it adds a really interesting dynamic of making sure that we didn't buy the goodwill and then give the goodwill away right when our employment agreements came up for renewal, which I think is easy to do, particularly if you've had these transactions and maybe you as a compliance officer weren't involved in that initial transaction. Keeping track of all that. That's something I would put on my list to go back and look through.
Any other thoughts from any of you around the pandemic and the impact, probably more so around physician compensation and acquisitions? This is a really tough question for you. I realize that, but there's been a lot of changes, obviously, with telehealth and volume swings. And I think, Anna, you already somewhat addressed that when you talked about the compensation and looking at some of the compensation studies that are out there. What are you seeing currently people doing around the pandemic related impacts? And because there's obviously the volume side, but there's actually a cost issue that we're kind of in the middle of right now too, with respect to not only supplies, but human resource costs that may have some lingering effects. Any advice or thoughts for the audience? I know this is a tough one because we got to get our crystal ball out on this one.
I can take this one first, Anna, if that's okay with you.
Please.
So from the valuation of a practice standpoint in an acquisition, valuation is always going to be forward looking. So it's saying, what does the future of this business look like? Not the future of this business if we undergo, a $10 million renovation and we project out this, which we can do, but it's as the business is right now, what does the future look like? A lot of times we can look to historical data for that. However, for some practices right now, that's not really feasible. So it's really getting an understanding of what has changed in your business and how can we modify these financial statements or work with you to understand your projection, to understand how that impacts the actual forward-looking financials for the valuation. So the first thing that's a little bit easier to do is to understand what kind of 2020 funding was received that was a one-time only thing. So whether it's PPP and it was anticipated to be fully forgiven, whether it was some HHS funds, understanding what those are and how they impact the financials. If they're one time, not going to happen again, then we're probably just going to remove them. But really getting our arms around what was all received and let's consider how that impacts operations. Another thing that we've really seen is that the changing payer mix, as businesses are opening and closing, does that impact what your payer mix look like as long as your patient load stays the same? So understanding how that's going to impact, are you now skewing away from third party onto more Medicaid, Medicare? Understanding those types of dynamics in addition to what sort of procedures, those CPT codes, the patient, the fee schedules, all of those, how they come together. So what used to be a little bit more of, okay, we've been able to build on this, or we've been able to increase our patients and that type of thing, is now a lot more difficult because we might have a base or a skeleton, but we have to understand how that builds out into the future. And the client really, the client has to put a lot more work into those assumptions as well.
Yeah, we've seen buyers recently ask a lot of hard questions around what does recovery from COVID look like? And telehealth has been really helpful for behavioral health practices and for primary care. Speaking very honestly, it's been quite difficult for surgeons and proceduralists. So they've got a lot of E&M codes and not as many surgeries. And so the financials for those practices look a whole lot more difficult, and some of the ambulatory surgery centers that come with them have as well. We have definitely seen payer mix deterioration that is hard to explain and hard to forecast. Is it coming back? Is the commercial payer mix going to come back the same way that it was previously? And so particularly as the unemployment payments continued on there in multiple states. And so some of this has been a state issue as well, where we've had to look geography specific to see how Medicaid was rolled out and how many folks are still on unemployment rolls to try to figure out the payer mix side of this. But yeah, trying to figure out who's recovered and who hasn't and who's going to recover has been one of the more difficult and I would say intellectually interesting components of my job recently. And then how, what's a buyer willing to pay for that?
I was reading a recent report by one of our larger consulting firms, and they kind of seconded what you just said, Anna, around telehealth and the benefits and pitfalls of it, and where people have seen the benefits. And certainly at primary care, mental health. I also saw that physicians tended to think some of the follow-up care was better or more effective in that environment, where it's more of a consultative type of arrangement versus a true examination. Even some of the pediatric side, where you have parents that are trying to figure out what's happening with their family and kids, that's been more effective. You don't need a whole half hour, 20 minutes. You can do this in short order. So those things have been effective. There's still some issues out there, obviously, with the technology, and certainly there's some racial disparity there too, as far as how this works amongst the different populations out there too. So yeah, so we'll learn more as we move forward with it. We do have a couple, before we wrap up, we've got about 10 minutes left, and I wanted to shift over to Scott, but we have a couple questions, and I don't know if we want to respond separately, but I thought I'd throw them out there. I don't know if Scott, Anna, or Kristen have seen. Nathan asked a question about, with increases in 594XX and 99XXS E&M codes, are you seeing facilities adjusting the conversion factors down to calculate work RVUs? Don't know if anyone wants to answer that, or we can do a little research and follow up on it. But I did mention we try and respond to them. So
yeah, I'll respond to that. I'm in the middle of a lot of those right now, and yes, I do think a lot of the providers are having to decrease their compensation per work RVU across the board to account for the increased work RVU volumes for the exact same services. I won't lie, it's been a tough slog trying to explain to a physician, your work RVUs went up, yay. Medicare didn't pay for it, bummer. Your commercial payers probably didn't pay you a dime extra for it. And it didn't cost any less to provide that care this year, has been a tough conversation because it's a service mix, payer mix, economics, everything all combined. We've had some clients who decided to keep their powder dry in 21 and hope that in 2022 they could figure that out more easily and make that adjustment there. With the new fee schedule, I think it's going to be the same problem again. The fee schedule that came out last week. So again, Medicare is proposed to decrease again this year, starting on January 1st. And so I think the hopes that this would sort of shake out, maybe for now, I don't see those hopes coming true. So we definitely see people saying, I can't afford to pay 15% more to my physicians. And I'm certainly saying, I'm not sure that it's fair market value for everybody to get a 15% raise for doing the exact same thing when the economics aren't there to support it. So yes, we have seen folks decrease their compensation rates for that.
thanks. And then there's another question. I'm not sure who this would be directed to, or if we have to need a little bit more information. How will MPFS changes impact the commercial reasonableness of compensation for providers going forward? It seems that those employed providers would be much more insulated from the changes rather than independents, which seems as though could create challenges for valuation. So that's maybe a bit more down the valuation front.
I think that's an increasingly difficult issue of the hospitals have a larger bank account to pull from when things maybe don't turn out exactly their way, and the private practice physicians only have enough in the bank to pay themselves. And so we are definitely seeing the private practice physicians feel the hurt of this Medicare decrease a whole lot faster than the employed physicians. And it's a concern for me of what, fair market value needs to be the entire market, in my opinion. And I'm sure Kristen would agree, from a market approach. And so when we have two different groups feeling it very differently from an economic perspective, that's a concern. It's something we are still grappling with, for sure.
Good. Well, those that ask the questions, if we're not on point on those, just send a follow-up, or we can certainly follow up directly with you and give you a call to talk about those questions or issues you have and help you out a little more specifically. I know in this medium, there's always a little bit of challenges in trying to have that back and forth on it. Scott, we're going to go back to you. We gave you a little breather here. First of all, anything on an OIG or DOJ after listening to, Kristen and Anna talk about acquisitions that you want to talk about, and then maybe you can transition right into board governance and some of those things that any organization should make sure they have on their plate and are being done. So,
well, that's certainly a meaty topic, Scott. Thank you for that. I guess the only
in 5 or 6 minutes, right?
Yeah, I guess what I would add on the transactions front, I really appreciate the discussion from Anna and Kristen on that. I think the point we would add there would be, we see a lot of transactions where there are problematic arrangements on the system or the hospital, particularly, that's about to be acquired. And we see a lot of the acquiring entities kind of put as a condition on the closing that the particular arrangements that have been identified, typically through due diligence, have to be self-reported prior to closing, because there's successor liability under the Medicare program. The last thing that an acquiring system wants to do typically is to inherit arrangements that may be problematic from the entity that they're acquiring. And so we oftentimes see a lot of self-reports regarding physician arrangements coming from the due diligence that's done around the transaction. With respect to the board question, and I'm glad we have a little bit of time for that, because that's a critical question in our view, particularly for all the compliance folks who are on the call right now. We've discussed that physician compensation arrangements may be the single biggest risk item your compliance program is going to face. Obviously, that depends on each organization and the particular compliance issues that you have. But on an ongoing basis, physician compensation arrangements are going to be high risk based on, the federal requirements that we've talked about. So ultimately, it's the board that's responsible for making sure that the provider has an effective compliance program in place. And so I think it stands to reason that the board then should have at least some passing awareness of what the general requirements are for compliance regarding physician compensation arrangements. And what we typically see is, when you onboard new board members, particularly, for example, in a hospital board or a hospital system, they're given some education before they come on board to understand better what some of those risks are regarding those physician arrangements. And then on top of that, as part of the annual board education that I think is kind of the gold standard when it comes to effective compliance programs, usually there's board education too about what the requirements are, what some of the risks can be, and how basically to maintain a very proactive compliance, compliant physician compensation review process. So really can't overstate the importance of having that type of board education regarding, this type of arrangement.
And Scott, I think you're right on point. I think the other thing I always, like to think through too is for board members, and oftentimes the board members are successful in their business or in other philanthropic areas, and some of the requirements or rules are almost counterintuitive to what you do in a business. Yeah, I mean, I want to incent someone to refer business to me, right? That's what I want to do. And I want to incent someone to provide more services in a certain area because it's good for the common cause. Well, you got to be careful. And in fact, I think maybe Scott, you mentioned this to me, but I thought I read something about one of the things you run into sometimes in these deals is emails from board or back and forth to management around these things that are probably not worded as well as you'd like around the incentive that are being put in place. So
Yeah.
just something to watch out for. And that's where the education comes in, obviously.
Yeah, I think that's a good example, Scott. I mean, the government loves to find emails. People think, for some reason, I think that emails don't become part of the record or, won't be identified later. But oftentimes in our experience, that's the first place that the government looks. And if you have folks involved in the process that don't understand, the risk parameters, those emails can kind of sink a ship before it even sets sail. So it's important just to make sure everybody involved in that process is aware of what those requirements are, and to have the board who should be overseeing the compliance program itself and physician compensation in general is aware of what can happen when we kind of forget about what those requirements are that are so important to the overall compliance of the arrangements.
Thanks. Well, we are just about at time. We got maybe a minute here. Any last thoughts from any of our panelists on any of the topics, board governance or other key issues, items that organizations should think about in their compliance plans? And I'll open up the floor here to anyone who wants to add something.
From an acquisition perspective, I would just say that it's important to think about fair market value early on in the process. If you're looking to start talking to a potential seller, it's important that you don't offer something that you aren't going to be able to transact on later, because it is hard to walk that back.
I think that's a good one. The sooner evaluator can get involved, the better. We are seeing a good amount of noise right now around designated health services pools. Those are tricky to begin with. I know Scott would say those are hard to get right from a compliance perspective, but if you're on if you're paying physicians based off of the economics of their practice and putting, x-rays, MRIs, ultrasounds, all those sort of things, lab to the side and paying them out of those, the rules on those stark exceptions have changed and go into effect January 1st and have created a couple of really interesting issues there for our clients. So I'd put that one out there as well.
Yeah, the only other thing I would add, Scott, is for particularly when it comes to compliance reviews, to make sure the compliance process includes physician compensation arrangements, and to make sure we're aware of all the arrangements that are out there, and then also the ones really that are the outlier variety that we talked about.
And I like that comment, both last couple of comments here, Scott, making sure you have a complete pool. There's really some things you can do around data analytics now to really start isolating it. It's not quite as manual. So I for those auditors out there, that's something you can have a role in. And the designated health pool is a very complex process, or new rules. So if any of you have questions or want to learn more, I urge you to reach out to people that understand it, like Scott and Anna and Kristen. So with that, we are at time. So I want to make sure people get off with their day. Amy, any last thoughts for people? If you have questions, feel free to reach out to me or anyone on the panel. I'll be happy to manage those questions. So.